where to put your money when saving for a down payment. So you're saving money to buy a home, and you can't put all your money in the stock market because that's too risky. But you can't leave your money in a savings account either because it's not going to earn you much and it can't even keep up with inflation. There needs to be a balance where your returns outpace inflation, but you also control for that downside risk. So here's a portfolio which limits the volatility, but also gives you a pretty decent investment return. It's composed of 75% bonds, 15% utility stocks, and the remaining 10% in REITs. Let's call this a home down payment portfolio. This is the performance over the last 5 years compared to the stock market index. The blue line is the custom portfolio, and if you had invested $10,000 5 years ago, it would be worth over $13,000 now. That represents a 5.4% annual growth rate. This is a way better return than just keeping your money in a savings account, and it beats inflation as well. In terms of volatility, it only has a standard deviation of 5%. The most it's lost over a month is only 7.2% compared to 22.5% for the general stock market. And more importantly, when it did go through that drawdown period, it only took a few months to recover all it had lost compared to much longer for the S&P TSX composite. And that's why this portfolio has a relatively higher Sharpe ratio, which means it performs better on a risk-adjusted basis. You certainly still have that short-term risk. So if you plan to use your down payment over the next 3 to 6 months, then maybe just hold that in a high interest savings account because you know you're going to be using it relatively soon. But if you're just getting started to save up a down payment, or you know it's going to be more than a year before you buy a home, then this custom portfolio is worth considering because in any one given year, it hasn't lost any money. And this will also offset future home price appreciation. Canadian home prices have historically increased about 3 to 4% on average a year, depending on where you live, of course, and this custom portfolio can certainly get you those returns or higher. Let's take a look at what's exactly in this portfolio. The bulk of it is going to be a short-term corporate bond index ETF. The bonds are short-term in duration because you don't want a lot of interest rate risk, and you want investment-grade corporate bonds because they pay a higher yield than government bonds. For example, you can use VSC, which is the Vanguard Canadian Short-Term Corporate Bond Index ETF. Its top bond holdings are blue chip companies that pay out a 2 to 3% coupon. Index funds like this are very stable. You can see it generally trades within a pretty tight range, except for a few anomalies. So its low volatility makes this a great core holding for any defensive portfolio. The next piece of the pie is a 15% holding in utility companies. As an example, I'm using the iShares S&P TSX Capped Utilities Index ETF. This is just a basket of utilities including Fortis, Brookfield, Emera, Algonquin, and Hydro One. These are companies that supply power, electricity, gas to people's homes. So these companies tend to be somewhat recession resistant and are more stable than the broad stock market. The management fee on XUT is a little high, so if you want, you could just buy the individual holdings yourself. The top 5 holdings already make up more than half of the entire fund, so you'll probably get similar results if you just hold the top 5 individual companies. In terms of volatility, it does fluctuate more than the bond index we just looked at, but there's growth potential with this one, and it's still more stable than the general TSX. Finally, the last 10% of this portfolio is a REIT, and I'm going to use Canadian apartment properties here. This represents risk symmetry. So if I'm saving up to buy a residential property, then I want to be in a real estate investment trust that also invests in the same sector. That way, if the residential sector does really well, then the REIT goes up and I don't have to keep chasing higher and higher home prices and never being able to save enough for the down payment. On the other hand, if it goes down, that's fine too because I'm hedged with it. It's a symmetrical risk, meaning I can take a small dip in my portfolio because home prices are also cheaper, and I can buy the same property I was looking at but for less money. So if you want to invest your savings somewhere where it's not losing purchasing power every year, and you also don't want the big swings in the stock market, then a custom down payment portfolio like this is certainly worth looking at. Historically, when the stock market was doing well, this portfolio was able to capture more than half of those gains. And during a major bear market, this portfolio only fell 1/3 as much compared to the stock market index, and it was able to recover much faster. And this is only a base setup, and I think it can work for a lot of people. However, you can tweak the allocation to your liking. For example, if you want a slightly more conservative approach, you can have 80% of your holdings in bonds and 10% each to utilities and REITs. And what this gives you is a slightly lower annual return, but you'll temporarily lose less money during a major market correction. If if you live in the United States or you're saving up to buy a property down there, there's actually a new ETF that was just introduced earlier this fall called the Home Down Payment Investment ETF by LifeGoal. The ticker is suitably HOM. The purpose for this ETF is to give potential homebuyers somewhere to invest their down payment where it's relatively safe, but can also hopefully outperform inflation. The breakdown of this fund is roughly 60% in bonds, 30% in equities with a focus on the home building sector, such as Home Depot, Lowe's, and lumber companies. And the last 10% are in commodity-based stocks and cryptocurrencies for hedging against inflation and diversification purposes. Even though this ETF has only been out for a few months, they've actually back-tested to see how this would perform historically, and it's gotten about 5.7% annual returns. So that's similar to the Canadian down payment portfolio from earlier. In any case, if you're saving up for a down payment and you know it's going to take you 6 months or longer, then there are lots of alternatives you can put your money in that will actually get you some real returns rather than putting it all into a savings account or even a high interest savings account that's giving you 1% or lower. So I hope you got something useful out of this video. Thanks for watching, and until next time.